Hello friends, this is Dr. Amarjeet Kaur, Professor of Accounting and Business Communication at the Department of Management, Gurugram University, Gurugram. I am here with you this day to talk about risk analysis in capital budgeting decisions. So friends, it's been 3 or 4 past lectures that we talked about capital budgeting techniques. We discussed many tools or techniques of evaluating long-term proposals, be it net present value, be it IRR, be it ARR, be it payback period, etc., terminal value as well. So, all the techniques of capital budgeting, we have discussed, they do consider couple of things, but they do not consider risk in the cash flows or discount rate or possible risk all around, due to which the cash flows could be different, discount rate could be different. So, risks are not incorporated in any of the techniques which we discussed so far, and nevertheless NPV is the most commonly accepted technique, IRR is the most effective technique. So, those are very good techniques and we have discussed everything. And as we know, in capital budgeting decision, the expenses are made today, the outlay is today, and the revenue, the cash flows or the inflows are going to happen in future. So, there is a very long difference or distance in fact between the cash outlays and cash inflows. So, both are happening at different time period, and that is why the time value money discounting technique is brought in into the most of the techniques, excluding terminal where compounding is also brought in. So, why it is so important that we should consider risk into the capital budgeting decision? Because future is uncertain, our cash inflows are happening in future, which is not, we are just making assumptions about couple of things, we are making an assessment about the economic factors, social factors, political factors, and forecasting our cash flows, right. So, our cash flows are dependent on many factors which can actually change the expected outcome. So, it becomes very important and imperative that we do consider certain types of risks which we can foresee, we can assess into our capital budgeting calculation or decisions, and then our calculations would be conservative, it would be prudential. So, we have to have a very prudent approach in assessing the capital budgeting decisions. So, for that matter, there are so many types of risks which any company is likely to face, and we divide those risks into couple of categories or heads. The first one is project specific risk, the second one is competition risk, the third one is industry specific risk, fourth one is international risk, and the fifth one is market risk. So, what is project risk or the project specific risk? We have in our own country, there are a couple of states where the business culture is not very cooperative. I do not want to name those states, but there are states where we know the mafia is so strong that no business can operate without paying a certain amount of the profits to them, and so is true for many more countries. So, fortunately most of the part of our countries are safe and are well connected, but there are certain pockets, very small area where it's little more riskier than other businesses or than other locations. So, if we are planning a project, we are planning to launch a new product, new plant, new machinery, something in such area where the risk is higher, risk of any kind, that project specific risk is higher, because that particular project is is something belonging to maybe farmers, maybe it has to do with the local community, which which can be a troublesome situation. Those farmers, those local community may have objections, and we may not get approvals from the local bodies or regulatory bodies because for that particular specific project, because that project has risk of or has some kind of hazardous output or hazardous expected outcome or impact on the communities, etc. In that case, the risk of not being able to operate or not being able to operate fully in full capacity is very much there. So, such risks are project specific risk. Is something known to everybody that what happened to Nano. When Tata launched Nano, there was a issue with the farmers' acquisition of land and the state government, and finally the Tata has to move their plant from West Bengal to Gujarat, right. So, that particular risk was project specific risk, and a good example. Same way, there are so many more situations where we would have risk pertaining to the project only. So, that is one type of the risk. Another is competition risk. Competition keeps on changing. You may have made a forecast of cash inflows looking at the current scenarios. You may not have been able to apprehend what will happen in future. Suddenly, there could be a fierce competition all around because that particular sector which you are operating is very lucrative. People are realizing it is becoming more lucrative, and people may enter into that sector, right. Your cash inflows, your share of the business which you actually assumed, assessed is going to be challenged, it is going to be reduced. So, that is competition risk. Then we have certain risks which are specific to industry. Certain industry which are prone to weather, seasons, prone to certain political developments. So, those industry specific risks are also going to impact your cash inflows, your outcome for the project. Then we have international risk. We know what is happening nowadays. Every country whosoever was dealing with USA, they are facing these issues of tariff rise, right. That is an international risk. So, the same kind of risk could be pertaining to other issues as well, not only the tariffs, it could be supply of raw material. If you are into a business or industry which was dependent on certain other countries for procurement of raw material. So, there is always a risk, and we know what happened during corona times. The whole supply chain industry was disrupted for semiconductors, right. The manufacturing of cars was almost stopped by many manufacturers because of non availability of semiconductors. So, and this is a fact. So, that kind of risk is international risk, where you are dependent on the international suppliers, vendors, or the foreign currency, right. If your payments were supposed to be in foreign currency, there is a risk. If foreign currency goes up or down, there is a possibility of risk, right, depending upon you are an exporter or an importer. And lastly, the market risk is always there. So, it is not certain that how much market share you would be able to fetch. So, these are the possible, and there are many more types of risk. So, we need to incorporate or we need to consider these risks into our evaluation for capital budgeting proposals or long term proposals. So, we have couple of techniques which are used to incorporate risk in capital budgeting. We would be discussing two techniques in the first half, and then we will be discussing two more techniques of capital budgeting in the future session immediately after this session. So, we have four major techniques which are used to incorporate risk into the capital budgeting decision. First one is so these are the conventional one. The first one is risk adjusted discount rate. The second one is certainty equivalent factor. The third one is sensitivity analysis. The fourth one is break even analysis. These are the four conventional one. Other than that, beside these four conventional techniques, we have three more techniques which are statistical technique, and those three techniques are probability distribution, simulation analysis, and decision tree approach. So, we are going to discuss about the conventional techniques today. So, the first conventional technique I want to discuss is risk adjusted discount rate. So, what is that? So, if you remember from the past 3-4 lectures we have spent on capital budgeting techniques, In all the modern techniques or discounting techniques, we were using one discount rate, right, to discount the cash inflows. So, in this method which is known as risk adjusted discount rate, what are we doing? We are adjusting the discount rate itself. So, it is a direct method of adjusting risk in capital budgeting, which is based on the premise that riskiness of the project may be taken care of by adjusting the discount consideration, because if we discount our cash inflows at a higher rate, the factor goes down, right, a factor goes down certainly further. So, our inflows, the total value of discounted cash inflow would be lesser. So, project would be actually incorporating the risk of any kind. So, this cash flows from the more risky project should be discounted at a relatively higher rate of discount. This is the premise of this particular technique. So, what do? We calculate risk adjusted discount rate, which is actually the risk free rate KF plus the premium for the risk. Now, the premium for risk could be more for a more riskier project and it would be less for a less riskier project. But this K column that denotes the discount rate, which is the risk adjusted one, which is equal to KF. The K is basically cost of capital or discount rate, which is for the risk free discount rate, plus P is the premium here. This is the formula which we use. For discussion purpose, I am clarifying this is what we use, but otherwise we would have the rate been given. As if we take this example, this case in which is in front of you, the case on risk adjusted discount rate. In this case, we are taking a firm which is considering investment in a project requiring investment of rupees 5 lakhs. The project has a life of 4 years. The project is expected to generate cash flows in year 1 through 4 rupees 2.5 lakhs, 2 lakhs, 1 lakh and 1 lakh, and N is 4, right, and total outlay is 5 lakh. So, further it says what is the risk adjusted NPV. So, what we have to calculate? NPV, which is risk adjusted of this project if the project is considered to be risky and the firm considers a discount rate of 15% as appropriate to discount the cash flows. So, we have to calculate risk adjusted NPV, RA NPV, right, we call it as RA and NPV. So, how would we solve this? We would discount all cash inflows at 15% subject and then we will subtract the outlay of 5 lakhs from the total discounted cash inflow to get risk adjusted net present value. So, risk adjusted RAN PV is equal to what? So, the discount value of all the cash inflow is coming out 4,91,550 and we will subtract the outlay which was 5 lakhs. So, my outlay is more than my cash inflows discounted at 15% since the project is riskier. So, it is giving us negative risk adjusted NPV. Since RANPV is negative, the project is not acceptable, right. So, friends, I hope you could gather, you could understand that this is a little variation of NPV. As far as calculations are concerned, are very much like NPV only. The only difference is the discount rate goes little up, right, for the riskier project. Otherwise, the calculation is very much same which we have already discussed in the past, NPV method, net present value method. So, this RANPV is very much similar and when it comes to calculation. Okay, the only difference is the discount rate is at a higher side because we have added the premium for the risk we are expecting. Now, that risk could be of any type as we discussed, it could be international risk, market risk, it could be any industry specific risk or the project specific risk. So, whatever type of risk you are assuming, we would take that risk into consideration by increasing the discount rate by few points. Had it been for example 12% of the discount rate in general for you. So, you can directly increase it to 15-16% depending upon the riskiness. So, if the one project is less riskier, other is more riskier, then the first project we will add less premium, in the second project we will add more premium for the risk. That is how it works. So, it is a direct method where discount rate is adjusted. The another method I want to talk about is certainty equivalent factor or approach. Here in certainty equivalent approach, it is a non-statistical technique of course, but what we do, we attempt to adjust future cash flows instead of adjusting discount rate. In the previous method, we have adjusted discount rate. In this method, what are we adjusting? We are adjusting the cash flows itself, and we know the cash flows are happening in future. So, the expected future cash flows which are taken as risky and uncertain are converted into equivalent certain cash flows using some conversion factor, and adjusted cash flows are then discounted at a risk free discount rate. So, what is happening in this method? We are going to change the value of cash inflows, whatever we otherwise assessed, by multiplying those cash inflows with certainty equivalent factor, that X factor is certain. So, what does it mean? It is actually considering the probability. So, say for example, if I am expecting to receive 10 lakhs in the first year of of a project, second year 20 lakhs. So, 10, 20 and whatever the amount in future could be. So, if I am assuming 10 lakhs to be received as cash inflow in the first year, 20 lakhs to be received in the second year, but my riskiness of the project is such that there is a probability that I may receive there is a 90% surety only that I will receive 10 lakhs, and there is only 80% surety that I will receive 20 lakhs in the second year. So, my certainty equivalent factor becomes 90% and 80%. So, what will we do? We will multiply 90% to 10 lakhs, it becomes how much? 9 lakhs. So, my certain amount or certainty equivalent amount which I can actually receive, or this is you may call it as adjusted cash flow after adjusting the certainty factor of 80%, 90%, my adjusted cash flows are 9 lakhs in the first year. In the second year, we assumed there is a possibility of 80% that you will be able to get 20 lakhs. So, 80% means 16 lakhs are certain. It is not certain, you may end up getting 21 lakhs even, making 21 lakhs. But how much is certain? Certain is 18 lakhs or 19 lakhs or or maybe 20 lakhs even. So, there could be certainty equivalent factor could be higher in a particular year if we have certain data, certain numbers with us that this event is going to happen, this function is going to happen, this weather would increase our chances, whatever, if we have something certain. So, certainty equivalent factor actually adjusts the cash flows, and those cash flows, it means it becomes the same situation like NPV situation where we have cash flows. Only thing is the cash flows are revised considering the riskiness or considering how much certain it is for the company to receive those cash flows. So, we convert those cash flows to a certainty factor with the help of certainty factor, and then we get the revised cash flows which are adjusted cash flows. Okay? And thereafter the next step would be that we would be discounting it, and then it becomes very much like NPV question, NPV situation. So, after discounting, we will have discounted value of cash inflows which we compare with the cash outflow, and the difference would be your net present value. Had it been positive, we will accept the project, or had it been negative, we will recommend to reject the project. So, that is how this certainty equivalent approach is used. So, I would be now taking up a small case to help you understand how to practically solve this situation or solve the question or problem with the help of certainty equivalent approach, CE approach. So, here we are in this case, this is a case of a book company, right. So, they are considering two projects, project A and project B, year 1 to 4, like 0 to 4, the life of the project is 4 years. The cash flows which are expected today, like 0 means today. So, project A is expecting to spend 3 lakhs and project B is expected to spend 4 lakhs, right. So, if you refer against 0, then in the first year we are expecting project A to receive 1,50,000, project B to receive 1,50,000, project A to receive in second year 1,50,000, in the third year 1 lakh, and in the fourth year 1 lakh. And the certainty equivalent factor is given here. For today it is 1 because it is certain that I will be spending 3 lakhs, 0 period, right. Then it is 0.95, 0.85, 0.70, 0.65, which means 60%, 65%, 70%, 85%, 95%. Okay, that is CE factor for project A. Project B has an outlay of 4 lakhs and it is expected to receive 2,50,000 first year, 2 lakh in the second year, 1,50,000 in the third year, 1,50,000, 1 lakh in the fourth year. And certainty equivalent factor is 1 for today, of course. Then we have 90%, 80%, 70% and 60%. And the question is which project proposal should be accepted by the firm, right, basis on the certainty equivalent approach. So, and the discount rate is also given 5%. So, how would we solve? I am taking the project A first. So, we have cash flows, we will just write down those cash flows. We will actually multiply the certainty equivalent factor. For example, in the fourth year, the certainty equivalent factor was 60%, if you remember, 65%, sorry. So, 65% was the certainty equivalent factor. If you multiply 1 lakh, I am referring to the last row. So, for year 4. So, if you multiply 1 lakh with 65%, it is giving you 65,000. So, my risk adjusted cash flows, refer to column number 4, RA cash flows, risk adjusted cash flow. I am starting from the bottom, fourth year is 65,000, then 70,000 in the third year, 1 lakh 27,000, 500 for the third year, 1,42,500 for the first year, right. And then 3 lakhs of course is same because equivalent factor is 1. So, by multiplying the equivalent factor we have risk adjusted cash flows. Okay. So, what is the next step? So, this is, so I hope you are clear with the first step. That first step you refer the question, we took the factor CE factor which is there in third column of this table, we multiplied it with the values of cash flows given in the second column, and from the bottom I started 1 lakh, 1 lakh, 1,50,000 and 1,50,000. These were the cash flows for the 4 years, and the discount and the CE factor is there. Multiplying the CE factor with the cash flows, we got a risk adjusted cash flows which are depicted in the fourth column of this table, right. So, what is the next step? So, up to this step we were calculating risk adjusted cash flows. The next step is to discount it. So, discount factor was given that company is considering 5%, and this is also something after considering the riskiness of the project. So, you need to go to the table 1 of present value table of 1 rupee and find out the discount factor at 5% for 4 years, year 1, 2, 3, 4 for all the 4 years. So, 0.952, 0.907, 0.854, 0.823. So, these are the factors you will find in the table. So, in this step you will note down the factors in one column, and then what is the next step? Multiply the discount factor at 5% rate of capital cost of capital with the risk adjusted cash flows, column 3 and column 4 I am talking at this moment. So, multiply column 3 with the column 4 and you will get the present value for individual year, for each year, and then we will sum up the we will make a sum up of all the cash inflows after discounting, that is present value of cash flows and we will sum up them together and we will subtract the outflow of 3 lakhs which is in bracket, bracket means minus of course. The difference would be your risk adjusted net present value which is coming positive here. You can see we have 65,200, this is a positive value. So, your risk adjusted net present value is coming out to be 65,280 for project A. On the same pattern, you can calculate risk adjusted net present value for project B which is coming out to be 99,420, and comparing these two values project A and project B has a higher value of risk adjusted net present value. So, it means we should be recommending the project B to the company. So, you can have a look at the project B here. So, the data was shown to you. That same way as we calculated project A, I would recommend you to calculate, follow the same step, prepare a table for year, first column for year, second column for cash flows for project B, third column you can take certainly equivalent factor, multiply equivalent factor with the cash flows and you will get the risk adjusted cash flows, and then multiply that with the discount factor and then make a sum up of all the cash flows which are discounted, or otherwise we call it as present value of cash flows, and compare it with the outflow, right. So, that is how we reached to the conclusion that project B is better after calculating RA and PV. So, this is how friends we use both the techniques. One is the discount rate adjustment and second is the certainty equivalent factor where cash flows are adjusted. So, both are commonly used techniques, and by this way we are actually using NPV where in the first method discount factor is adjusted, in the second one the cash flows are adjusted. I hope I was able to help you understand these two techniques. I would like to wind up now. Thank you very much.